Hi, and welcome to section 2.2 for Econ 2 on the AQA exam board. Today we'll be looking at GDP, we'll be looking at how to work out GDP, the difference between real and nominal GDP, and GDP per capita. So what is GDP? GDP stands for Gross Domestic Product. GDP is the monetary value of all goods and services, be it finished or semi-finished, that have been produced in an economy in a specific time period. GDP is usually measured annually, but it can also be calculated on a quarterly basis. There are three ways to measure GDP, and they will all give us the same value. The first method is the output method. The second method is the expenditure method, and the final method is the income method. The first method is the output method. This method looks at the value of the goods and services that an economy produces. This can be obtained by recording the value of final output. By solely looking at final output, we overcome the problem of double counting. We ignore the value added in the intermediate stages and instead look at the final retail price, which is the cost of all production plus profit. Let's take an example. Suppose we had a laptop that sells for £500. The output method takes the final value of the laptop, which is £500. This laptop may be made up of £200 of components, £100 for the assembly of these components, £50 of marketing, and £150 of profit to the entrepreneur who organises the production of this laptop. Suppose that each of these parts of producing the laptop were conducted by different firms. If this was the case, we would have to make sure that we did not double count. This is because if we summed all of the different production parts together, this laptop would add a value to GDP of £850. This figure arises because the component company sells the components to the entrepreneur for £200. Then, the firm who puts these components together charges £100. The firm who markets the laptop charges £50, and the individual who buys the laptop pays £500. So we have 200 plus 100 plus 50 plus 500, which gives a value of 850. So when we are calculating GDP, we need to make sure that with the output method, we are only counting final output. Another way to calculate GDP using the output method is to look at the value added to a good or service as a result of the production process. The value added is worked out by the value of production minus the value of intermediate goods. Let's use our laptop example again. The firm who creates the components adds a value to the components of £200. This is because they take the raw materials and produce components from it, which has a value of £200. The firm that assembles the components adds a value of £100. because they buy the components for £200 and sell them for £300. The marketing firm then adds £50 of value, and the entrepreneur adds £150 of value, which is their profit for bringing all of the factors of production together and having the idea and the money to finance it. So the total value is £500, which is £200 from the components, £100 from the company who puts the components together, £50 from the marketing firm, and £150 from the entrepreneur, which works out to be £500. So this laptop adds a value of £500 to GDP. This method is used for all goods and services to work out the value of GDP in an economy. The second method of working out GDP is to use the expenditure method. This looks at everything that is spent in the economy. It is calculated by measuring aggregate demand. The equation for GDP will be GDP equals C plus I plus G plus X minus M, whereby C is consumption, I is investment, G is government expenditure, X is exports, and M is imports. So the expenditure method is everything that is spent in the domestic economy. The third method for working out GDP is the income method. This looks at the incomes generated from the production of goods and services. We sum up the total level of wages, profit, rents, and interest in the economy. Only incomes which are generated by the production of goods and services are included in the incomes approach. We exclude transfer payments as no good or service has been given in return for the money that has been transferred. Income that has not been declared to Inland Revenue and Customs will not be included in this method. It was estimated in 2013 that around 150 billion of income was not declared to HMRC. This means that the calculated value for GDP could be around £150 billion lower than it should be. All three of the methods for calculating GDP will miss out income if it has not been declared. This is known as the shadow economy and is estimated to be around 13% of GDP. The shadow economy tends to make up a larger percentage of GDP in developing countries. There is an incentive for governments to try and stop the shadow economy because the government misses out on taxation revenue. And the larger the shadow economy is, the more taxation revenue the government misses out on. The three methods of calculating GDP must yield the same value for GDP. Therefore, national output equals national expenditure, which equals national income. National output is calculated by using the output method. National expenditure is calculated by using the expenditure method, and national income is calculated by using the income method. It is important to measure the level of GDP as it can give us information on the rate of economic growth if we compare GDP figures across years or across quarters. It can also give us information on living standards, and we can also see what the distribution of income is. When we look at the value of GDP, we need to distinguish between nominal GDP and real GDP. Nominal GDP gives us the value of GDP and does not take into account inflation. Real GDP does take into account inflation. To work out the real GDP growth rate, you do the nominal GDP growth rate minus inflation. If the nominal GDP growth rate was 5%, and the level of inflation was 5%, then in real terms, GDP has stayed constant. Because of inflation, economists prefer to look at the level of real GDP growth to judge the performance of an economy. If an economy is growing in real terms, then the economy is producing more goods and services. However, some economists would argue that a better way to look at GDP is to look at GDP per capita. GDP per capita is worked out by dividing GDP by the population. GDP per capita is important because living standards are closely linked to the level of GDP. If an economy grows in real terms at a rate of 5% and there is an increase in the population by 10% through migration, then real GDP per capita will be lower than it was in the previous year. If GDP per capita is at a lower level, then the population could potentially be worse off and have lower living standards. GDP per capita and real GDP growth rates are ways to assess the performance and health of an economy.